So this is interesting. I had a call with a client this morning. I thought this would be really helpful to some of you. So spoke to a woman that was moving up from California, and she's expected to move end of May for a new job, and she's for the last I think since February of this year, she hasn't been working, so her income's going to be quite low for 2026, and she's coming up with some investments, and specifically a fairly large IRA. So when we were talking, kind of strategizing about what can make sense, and we have a lot more to do with the planning, but this one's interesting, and this is a good example. It doesn't always work out this well. But considering her income is relatively low, she'll be able to pull quite a bit out of her regular IRA before she becomes a Canadian tax resident and move that into the Roth IRA. Now, of course, she's going to pay tax on the US side on the IRA distributions before those go into the Roth IRA. But the advantage there is once the money's in the Roth IRA, she becomes a Canadian tax resident. And of course, she's going to have to file Roth IRA elections on the Canadian side. Most do. Make sure that the account stays tax-free for both Canadian and US purposes. But now all that money that was kind of stuffed into the Roth before becoming a Canadian tax resident will be tax-free in perpetuity on the Canadian side, will grow tax-free, and eventually once distributed will be tax-free for both Canadian and US purposes. And the difference there is really significant. The IRA right now is quite large. So if you calculate what her RMDs will be upon retirement, so I don't know exactly what the RMDs will be, but based on the IRA, you're probably in the range of, let's say, $250,000 to $300,000 a year. So that would be income that would be fully taxable in Canada, and the US. But when we're doing this planning, definitely the Canadian tax side is going to be the higher tax jurisdiction. So those are pretty significant RMDs. So to the extent that any of that IRA money can go into the Roth IRA, those amounts that will be pulled out in the future will be at a zero tax rate. So the savings there, depending on how much we actually push into the IRA, will be significant. So that's definitely something to look out for. You're moving up to Canada, and especially in the year before you move, or the 2 years before you move, if you're doing the planning ahead of time. If you think you're going to have some years where your income will be quite low, there's a huge opportunity to pull some money into your Roth IRA to save on taxes in the future. Just wanted to share that, some planning that we often do for clients moving up from the US to Canada. Hope that was helpful, and stay tuned for more videos like this.